Seth, great to see you. Thanks for joining us. I guess the first question is whether, for you and your colleagues at Morgan Stanley, today's testimony really changed the outlook for what the Fed's likely to do in the year ahead, and what your conclusion is on that front.
So I don't think today's testimony changed things. I think it reinforced the message that we got first a flavor of from Chair Powell at the press conference for the December FOMC meeting. And then when the minutes came out, they really went into lots of detail about just how much they're prepared to start unwinding the balance sheet this year. And then if you look at market pricing, the market's basically fully pricing in a rate hike in March. And so if balance sheet runoff starts to happen shortly thereafter, you're talking about both tools that the Fed has at its disposal to start to tighten financial conditions.
So are you expecting yields to continue their surge that we've seen already year to date, or do you think we've kind of moved enough already in the short term?
I think that's a little bit difficult to say. I mean, the recent moves have been very, very sharp. And I think if I talk to our colleagues in rate strategy, they wouldn't expect to have continued movements as sharp as what we're seeing now. But over time, yeah, I think it would be natural for rates to continue to back up a bit, both real and nominal. Part of that is getting closer and closer to the actual liftoff of the short-term interest rates. And then I think the market's still going to have to sort through exactly how much of a price reaction this unwinding the balance sheet is going to take.